Index investing has become very popular for a few reasons. The costs can be very low, it's low maintenance, and much research has shown that many investors fail to match the returns of indexes over long periods of time, which means tracking an index can lead to outperformance versus other investment styles. Let's take a closer look at what index investing is. An index is a group of investments that are selected to provide a measure or gauge of a certain market segment. Broad market indexes can serve as a measure of how well a country's overall stock market is performing. For example, the S&P/TSX Composite Index and the S&P 500 Index are comprised of securities that reflect the overall Canadian and US stock market indexes, respectively. When people want to know how the Canadian stock market is doing, they look at the S&P/TSX Composite Index performance. For the US stock market, they will look at the performance of the S&P 500. They can also look at the Dow Jones Industrial Average, which most people just refer to as the Dow. Fixed income markets have indexes as well, and you can also have indexes that are reflective of different segments of the markets, such as a small cap or mid cap index. If we look more closely at an ETF that tracks the S&P 500 index, we can see it is made up of the stocks of the 500 largest publicly listed companies in the US. The weight of each company in this index is based on how big the companies are. The bigger a company is, the larger its weight in the index. That means that if the biggest companies in the index go up in price, this has a bigger impact on the index return than if the smallest companies in the index increased in price. The overall performance of the index is based on the weighted returns of the index member stocks. Let's use a simple example to show how this works. Imagine we only have two stocks in an index, and we'll just call these Company 1 and Company 2. Company 1 has a share price of $20 per share and has 100 million shares available. Its market capitalization is $20 per share times 100 million shares, which equals $2 billion. Company 2 has a share price of $10 per share and has 50 million shares available in total. Its market capitalization is $10 per share times 50 million shares, which equals $500 million. As a proportion of the index, Company 1 has an 80% weight and Company 2 has a 20% weight. If both companies' stock prices go up by 2%, then the index's return is also 2%. But if Company 1's stock price doesn't change and Company 2 goes up by 2%, then the index only goes up by 0.4%. We get this number by multiplying the weighted average of the returns for each company. Company 1's weight of 80% multiplied by its stock price change of 0% equals 0%. Company 2's weight of 20% multiplied by its stock price change of 2% equals 0.4%. We add these together and we get 0.4%. For an index with hundreds of stocks, the math is the same, there's just more of it. It would be easy to copy our sample index because there are only two stocks in it, but for real indexes like the S&P 500, which has hundreds of companies, that would be quite time-consuming. This is where index funds come in. Index funds are set up to match the returns of an index, and all you have to do is buy units or shares of the index fund. Because index funds are copying the holdings of a market index, the costs of maintaining the fund are very low. And again, that's because the mandate is very simple. Copy the index, don't make any changes. If you compare this to an actively managed portfolio, one of the reasons costs can be higher is because of higher transaction volumes. Whether you are doing your own trading or hiring an actively managed fund to manage your investments for you, the more buying and selling of securities that takes place, the higher the transaction costs will be. An actively managed investment fund will also have higher costs because it will pay for research analysts and fund managers to make investment decisions in line with the fund's mandate. These salaries increase the costs of running the fund, which means the management expense ratios, or MERs, of actively managed funds tend to be higher than index funds. The overall cost is one of the main reasons why index investing has become so popular. If we look at a hypothetical index's return here, we could consider a few options. We could use an index fund and we will get a return that generally underperforms the market return by a small amount. Or we could use an actively managed approach which has higher costs. On average, that means that the returns of all actively managed strategies for this market will underperform by the extra costs. And while some actively managed strategies will outperform an index, studies have shown that this happens a low percentage of the time. This is essentially because any actively managed approach not only has to outperform the index returns, it has to do so after subtracting the higher transaction and management costs of active management. As you may have noticed, there are a lot of compelling reasons that explain why index investing has become so popular. Low costs, low maintenance, and returns that are hard to beat.